Hi, I'm Michael Neuenschwander with Outlook Wealth Advisors, a CPA certified financial planner. In prior videos, we've talked to you about considerations for Roth conversions, considerations on how to have a plan in retirement, a retirement cash flow per se. Today, we want to talk a little bit more about withdrawal strategy. Where should you take the money from first when it comes to retirement? Now, while you're working, so you don't have to give a whole lot of consideration to sort of retirement taxes and exactly where to take the money from. That may be a little bit of an afterthought because primarily, you don't have a whole lot of options or you don't need to worry about it. You got your regular earned income, taking deductions, sort of go on down the road. In retirement, however, taxes shouldn't be an afterthought. They're really more of an integral part of your retirement plan. So in today's video, I want to give you a little bit of framework about how to decide or how to set up an optimized withdrawal strategy, meaning which accounts should you draw from first. Most people, as they arrive at retirement, have at least 3 tax buckets, meaning you've got an account that's a brokerage account, call it an after-tax account. When you have money in there, interest, dividends, capital gains, all that's taxable right away, shows on that tax return. Then your other accounts, you've got, in many cases, a traditional IRA 401k. When you put the money in, no taxes while it's in there, but ultimately, every single penny that comes out goes through your tax return. And now you may also have a Roth account, which we've touched on before in terms of looking at different strategies of doing Roth conversions and getting money in there. But one of the benefits is that Roth account is completely tax-free. Now, for obvious reasons, if you can get your money to grow tax-free, that's certainly better, than the alternative. So as we look at those types of accounts, we're going to look and say, well, what type of strategy makes the most sense for beginning to pull that money out as you need it in retirement? So first, let's talk about some of the issues with each account. As we mentioned, that after-tax account, you're going to pay taxes on interest, dividends, capital gains every single year. However, those are generally taxed a little bit less. Your IRA account, on the other hand, says that's taxed as ordinary income, and eventually you have what are called required distributions, where the IRS makes you take money out. And those may start at age 73 for most of you, but for some of you, it may be a little younger. It could be as late as 74, 75. And in rough numbers, that required distribution rate starts at a little under 4% and goes up, every single year. So if we began to rank these types of accounts and say, well, what's the most beneficial to the least beneficial, we can look and say that the Roth IRA is fairly easily ranked number 1. There's no required distribution. Anything it grows to, provided certain rules that it's there 5 years, but anything it grows to is tax-free, no required distribution, tax-free if it's passed on to beneficiaries as well. Then if we jump to the other side of the coin, says, well, what's usually considered maybe the least favorable from a tax point of view? That's going to be your regular traditional IRA. It comes with what we would call forced income, or as we said, required distributions. Now, the penalty for missing a required distribution, well, congratulations, they dropped the penalty to only 25%. It used to be 50. But the big part on those required distributions is you lose some control. And so ideally remaining in control so you have an idea of what your tax picture is going to look like is the goal. So if we look at your regular taxable account, in one sense it has forced distribution as well. It's just taxed at a much different rate. So in today, if we said if you had dividends or capital gains show up, qualified dividends, long-term capital gains are generally taxed at 15%. If your income's higher, they could be 20 or 23.8. But also keep in mind for some people, those are actually tax-free. So if you're able to stay in the 12% bracket, those qualified dividends and long-term gains are actually tax-free. So as we look at those various types of accounts, if we had to rank them again, we'd say the Roth IRA is the most tax advantaged. Your regular brokerage or non-IRA account is second, and sort of the worst from a tax scenario is that traditional IRA. So to give you an example of that forced income in the form of a non-retirement account, suppose you've got $500,000 in that non-retirement account, it generates 2% per year in dividends. That's $10,000 that's going to show up as taxable income on your on your tax return. Of course, $1 million generates $20,000. And so even if you don't take or use that income, it's still going to show up on your tax return and you're going to have to pay some taxes on it. The exact amount of tax you pay depends on the rest of your income, and it depends on whether those are qualified dividends or long-term capital gains rates. So if we say, what's the most traditional method when it comes to taking money from your retirement? So the most traditional method is simply to say that we take withdrawals from your taxable account, first. As well, if I'm having to pay taxes on that income anyway, I may as well use it. So in many cases, you can think of that as what they call the leaky bucket, meaning it's there, it's growing, but there's constantly some money having to come out to pay some taxes. Then you take it from your Roth, potentially. It says, well, now that leaves your IRA untouched. And while you save taxes early on in the beginning by using the Roth and the non-retirement account, that leaves the IRA continuing to grow. And ultimately, because you didn't do anything about it, it may force you into required distributions that are now producing more income than you actually want. So that kind of strategy, while it may save you some money early on, it actually could potentially forces you into higher tax brackets for the long run. So let's take a look and say, what if we totally reverse that strategy? And it says, pretend for a moment we're going to use $50,000, and it says in this example, it says we need to get that $50,000. Instead of taking it from just the taxable account and then the deferred account, can we have some savings there instead? So now let's take a look at a strategy if we totally reversed what we were doing. And in this case, let's actually begin to use some of the IRA money first instead of second or last. So when we do that, so we begin to use some of the tax deferred account to generate some of this income, it does two things for us. While one, it is going to show obviously as taxable income, we can control how much is taxed because we're not subject to required distributions yet. And the more we get out of the IRA, the more it helps to lower those required distributions down the road, so you're not put in a position where you may actually have to be forced to take more money out of that retirement account than what you'd like. And so while that's a fairly simple, framework, as well, we either do it traditional way or we do it the reverse, the good news is there's actually lots of additional options to go with it. So while we look at the two most basic options of simply doing sort of the standard and then reversing that, the good news is there's actually lots of different strategies. Those different strategies tend to be made up of doing a little bit of each. So it's not a all or nothing, proposition. And the goal of sort of mix and matching and controlling what those distributions look like is ultimately to benefit, some tax savings. So rather than simply chalking up and saying, well, the IRA is the third best account, maybe we begin to go back and have that Roth conversion, discussion. We've covered that in previous videos, so if you're wondering, what do I need to think about or should I consider a Roth conversion, be sure to watch one of those prior videos. But as we look at this and say, can you convert some of that money that is normally taxed as regular income throughout your retirement, by being proactive, can we convert that to now tax-free income? So when we begin to look within that framework of saying it's not an all or nothing decision, can we mix and match where we get the income, not just to save you a little bit of money today, but ultimately to save some money in the long run? Now, as we look at how to use an IRA and fit that into your retirement strategy, I do need to throw out one little caveat, there as well. Obviously, people listening to us today, some of you may have millions saved for retirement. Some of you may have, only a few $100,000. When we talk about certain strategies, if somebody is on the lower end of that scale and they say they have less than $200,000 saved in retirement accounts, the reality is the required distribution may not be much of an issue. What I mean by that is, to start, that required distribution may be less than $8,000. And in some people's case, and we make this clear, so when we talk about tax strategy, it's not all or nothing. There is no, perfect strategy for everyone. So I'll give you a quick example for some people where they may have a modest portfolio, but Social Security covers the majority of what they need to live off of. In their particular case, doing Roth conversions may actually not make sense because Social Security is taxed based on the rest of your income. So for some people, if they largely live on Social Security and have a modest IRA, they may be able to take distributions from their traditional IRA that are tax-free anyway, largely because of the standard deduction and the way the math on the taxation of Social Security works. So I just wanted to point that out and say, well, as much as I like Roth conversions, by no means does it mean everybody should run out, and do them. So as we talk about using your various types of accounts to really benefit you in the long run and how to keep the IRS at bay, make the money last, and the best distribution strategy for you, one of those strategies, if you do have a larger non-retirement, that taxable account, may be to use that to help facilitate those Roth conversions. So by moving more of the IRA to the tax-free side and paying some of those taxes from your non-retirement account, ultimately leaves you better off in the long run by reducing that required distribution and allowing now the Roth to grow longer completely tax-free. And that reduces your IRA while also reducing your taxable account, but it's keeping the account that potentially has the best return because it's all tax-free working for you as long as possible. And when we talk about how to reduce taxes, the other side of that coin is how to preserve your wealth or grow your wealth as much as possible. And oftentimes implementing a few of those strategies at the same time or mixing and matching your distribution strategy is the right solution. It's not a all or one or 100% from one account or the other. Now, if RMDs are no longer a problem, or you've already done enough Roth conversions, whether you've whittled that down where it's not a problem, then the best withdrawal strategy is probably going to be go ahead and use some of that IRA along with your taxable account in order to control your tax bracket. So even when we talk about Roth conversions, converting 100% of your IRA is typically not the goal. The goal is, can you keep those required distributions to where they're reasonable and within a reasonable tax bracket that you can live with, both if you're married on a married basis and also on a single basis if something were to happen to you. Quite honestly, if we keep it real simple, if you've gotten yourself to a zero tax bracket, frankly, it means you've overpaid in taxes somewhere along the way because you're no longer taking advantage of your standard deduction or even the 10 or 12% bracket. So as we look then at how Social Security is taxed, if you can control the rest of your tax picture, then potentially you save money on the Social Security tax side as well. The Social Security is taxed based on the rest of your other income. So if you have a lot of other income, Social Security may actually be up to 85% taxed. However, in the example I used earlier, if the majority of a couple's income was coming from Social Security and not much else, that may largely be tax-free. Now, one of the things we consider in doing Roth conversions and looking at distribution strategy, there can be a potential to actually face what we would call a double taxation or a tax trap. What I mean by that is if somebody's income on the paper says they have $50,000 of Social Security, but very little of it is taxed, so well, great, I can do Roth conversions, I can take more money out of my IRA account. That may actually be a trap because that extra income showing up causes more of their Social Security to become taxable. So while they may think they're in a 12% tax bracket, the effective rate of taking more from IRA or taking more distribution may not be 12% at all. It may actually be 22%. So all of these pieces ultimately fit together to understanding what's the best strategy for taking money from your accounts. It depends on how much do you actually need, how much Social Security or pension do you have, what's your required distribution going to look like when it arrives, and how much do you have in your total portfolio. So there is no one answer for everybody, but as we look at it, I can with most certainly say the right answer is not an all or nothing solution. It's using all of the types of accounts you have at your disposal and fitting those together in a way that makes the most sense for you from both a tax strategy, but also an investment and longevity strategy as well. So as we look at the best withdrawal strategy in retirement, hopefully we've enlightened you on some of the things you need to take into consideration, but the real answer is there is no one best strategy for everyone. It's going to take into account how much income do you actually need, what does your other income look like? Meaning Social Security, pension, dividends, royalties, etc. How much do you have in your retirement accounts, which will lead to what will your required distribution look like? Based on all those factors, then you can ultimately determine what's the best strategy for you. And those are the kind of things we do for people all the time. So if this information has been helpful to you, make sure you subscribe to our channel. And if you do have questions, comment below. But if you also you want to know, how does this apply to you? If we uncovered some things and there's additional information you want, feel free to reach out to us. Happy to have that conversation. So again, thank you for joining us. Have a great rest of the day.